great to do the session and host Dave. We got to know each other around the US real estate market and exactly what is happening right now, especially with the pandemic and the interest growing so much into residential real estate and a lot of people looking into rental homes. I think it has never been more timely at this point of time to have a discussion around what is happening in that market and to see exactly what investors can do to potentially take advantage of the opportunities that have been created in that sector. So without further ado, Dave, I want you to do the part from your own end about introducing yourself and also giving a small background of a small idea of exactly what your background is and how did you get to do what you are doing today?
Yeah, great. First of all, gentlemen, pleasure. Thank you for finding the time to be with us and an opportunity to share what it is that we're doing. I'm the CEO of Freedom Venture Investments. My COO, Eric Wilson, is also with us on this podcast, this Zoom call, this new format in which we get to share each other's skill sets. But Freedom Venture Investments is a middle market private equity company. It's based out of two parts of the United States, in Boston and also out of Fort Myers, Florida. I myself am an immigrant to the States. I was born in London. My team is all natural born. We bring a lot of diversity and skill sets to the company. Eric Wilson, the younger member of our team, has extensive operation skills, worked in the capital markets at Fidelity, brings all the systems and I always say he's the glue to the company, keeps everything together and moving forward with proficiencies. And then Chief Acquisitions Officer, Investment Officer is a gentleman by the name of Walter Novicki. Walter Novicki has 30 plus years in ground up development, multifamily repositioning throughout the Florida market. I myself have an extensive background in both the construction markets as well as residential distressed assets. I was blessed to partner with the Attorney General here in the state of Massachusetts, where I'm based in the Boston office, at the time of the crash. So our team has been through a couple of cycles. We know that they are cycles for a reason, meaning what goes up must go down. Being prepared for corrections throughout the markets is a critical piece of what we do. So very excited to spend some time with you folks, share with you why we are so heavily focused and invested in a newer, I say new, asset class in what's now being coined as BTR and BFR, built for rent or built to rent asset classes. It's not new. We'll all be very familiar with it as I break it down. It's rental properties, but it's a repositioning and a classification that has garnered massive amounts of capital attention here stateside, as we have been faced with quite a few challenges, which I'll share when I get into our presentation. So hopefully that lays a foundation for you to understand a little bit about who we are. And I'm open for questions, and I'll go through the presentation. I'll follow your lead on how you want to proceed with that.
That's pretty brief. And Dave, thanks for the introduction. So what we would do right now is, we would like to understand exactly what is the scope of opportunities in the rental market there for single properties, because that is definitely an interesting market. But then I want to start off with a question that, of course, an investor had raised around this in the group as well. That there's definitely a high level of FOMO that is being created in this industry, right? And it would be interesting to hear from you your take on this and why investors are flocking into this market. And on the downside, does that mean that this is the start of a housing bubble as well?
Yeah, those are some pretty intense questions. I love you bring up FOMO, right? The fear of missing out. Investing in its core structure is, am I in the right place at the right time? And I think to accommodate FOMO, the fear of missing out, an intelligent investor looks at fundamentals, right? They look at supply and demand. They look at population growth, all of the economics and the drivers that we as GPs and operators look at to determine are we in the right place at the right time? So FOMO is alleviated when people stop chasing imaginary yield. What I mean by that is that the multifamily existing structure market here in the U.S. has always been very strong. High net worth individuals, family offices, smaller institutional investors have coined the phrase that it's the Clydesdale of real estate investing, meaning you put the capital in, it goes to work over a 5, 10, 15, 20-year run, knowing that it's a nice, consistent yield profile on the deal. Now, what's happened stateside is that we've seen a massive compression in cap rates due to the massive amounts of capital that came into the marketplace. And what that did was the people that were doing the same thing the same way as they have done for the past maybe 5, 7 years in the market have now faced a dilemma in where to find yield. When we first started at Freedom Venture, we would put pro formas together on existing structures through repositioning and start talking about yield profiles to our investors anywhere between 6 and 8% cash on cash and internal rates of return over a 5, 6 year run at approximately 17, 18% is what we would pro forma out. Well, those deals are few and far between in the marketplace right now on existing structures. So to your point, is there a bubble in the marketplace? Well, I think the bubble is already there in the sense that the yield is very, very hard to find in existing structures. So as I said, when I presented or introduced myself to the group, we are middle market. We are a boutique private equity real estate investment firm, which means we have fluidity, which means we have the ability to adjust and move to always, we believe, to be in a position to supply the very best yield opportunities to our investors that join us on our journey. So what that means to me is this: to answer your question, I try and be succinct. It's not always my easiest forte to be succinct, but the market economics have driven us into the build for rent community because it is a structure that allows us to get back into a good yield profile. It is a structure that allows us to solve problems in the real estate marketplace. It's almost an inverse bubble where there is so very little single family property that is available for acquisition just to buy or straight up, build and sell, that it's created this asset class of build for rent communities. So I hope that answers your question, but it's got a lot of diversity attached to that answer, if you will, to be able to, fully encompass, FOMO, and also, are we in a bubble? So we're chasing yield. That's what we do to solve the problems in the marketplace.
It does answer my question to a degree. And I want to ask you another question, which I think is related to this and was asked by David, another investor in Quidroom in the group. So he had mentioned about that, is this demand right now, is this going to be short-lived, mainly because there was definitely a huge trend when there was lockdown during the pandemic, where a lot of people moved and started taking single homes for themselves, because most of them started working from home and remote working became quite a bit of a thing, right? So the concern that this investor raised is this going to be short-lived, especially because markets are opening up right now, and there will be a skew towards commercial properties, because the traditional commercial properties got hit quite a bit when the pandemic came, and with the changes and with the markets opening up, isn't it going to go back to normal? And would that cause more challenges for the residential market, especially the rental market, when the demand is going to go down? Allegedly.
Yeah. Great questions. Look, we have unprecedented pressures coming from different areas, if you will, in our residential economy. The first of which is the massive growth. I think nationally, the last statistic I pulled was like a 25% valuation increase year over year for residential real estate. well, that causes an action, right? For every action, there's an opposite and equal reaction, and to that, it causes a massive undersupply of residential properties. Number one. Number two, the properties that are in the market are being priced out of the affordability price index for the majority of the new homeowners. The ability to absorb the demand side for residential real estate is substantial. It's so undersupplied. So I've got rising price index on single family homes. I've got massive amounts of student debt being carried by our millennials, which is choking out their ability to afford a house at the same time. The social structure here in the U.S. is also very fluid in the sense of our millennials aren't necessarily committed to home ownership being part of their future. They are they move around more frequently. They're not necessarily tied down to any one community. So to be able to say, hey, I've got a housing supply that I can sell has some challenges attached to it. And it's creating the demand for single family homes for rent. The thing that's important to understand also is the majority of single family homes in the market nationwide are aged properties. 80% are owned by what we call mom and pop operators, small investor groups owning maybe 12 to 15 single family homes. They are not in a great state of repair. We saw this asset class come to life, if you will, on the back end of the last crash, when the larger institutions came in and bought up massive amounts of these foreclosed assets at steep discounts. And then as over time, they've learned how to property manage to service the tenants. Technology has played a large role in that as well, being able to oversee and manage these larger portfolios. But they're still old homes. So, the question is do we see this demand diminishing? Is it a fad? Is it a bubble in and of itself? Statistically, we emphatically say no. The need for this amount of asset is so strong. There is approximately, I believe the last count was 50 billion. 50 billion has been earmarked as capital into the market to support the build for rent single family community structure. And we're nowhere near that capital raise, if you will. As I said, middle market boutique. But we strongly feel we're in exactly the right place at the right time. And when I say right place, Florida, the population growth in Florida has been huge, and that's been a knee-jerk reaction, if you will, to the pandemic as well, moving to the southern states and also moving towards more business-oriented, friendly states as well. So, look, we all do our very, very best as investors to look at risk aversion and box out the corners, as I call it. But with that being said, the Florida market, the demand, the growth in population, the undersupply of housing, the fact that millennials and some of our retirees are no longer interested in existing multifamily apartment complexes. They want the green space of a single family home. They don't want the challenges of home ownership. We believe it to be a perfect storm when you put all those pieces together and start, mapping out a business plan for this.
That's pretty interesting, Dave. Now, I assume that right now, when it comes to Freedom Venture, you're mainly covering investments in Florida state at this point of time.
Yeah, correct.
Not outside.
Correct.
Right. And in Florida, how do you invest right now? Do you invest directly with other investors as co-investors into these properties, or do you have a fund structure right now?
Yeah, great question. Yeah, great question. So we started to look at the size of our pipeline. It's kind of interesting. Like I said, my partner, Walter Novicki's been down in the Florida market for approximately 30 years. So in real estate, it really is not just location, but it's who you know. Do you get first look, or if you will, or first insight into a particular project? So the amount of work that we can do or the amount of projects we can execute on really depends upon access to capital. And it's kind of an old adage, but no matter how much capital you have, you always need more. And what we did at Freedom Venture, and I believe my team has put some links in the chat to get more information to anybody interested. We put together an expansion fund. Our expansion fund allows for accredited and also some non-accredited investors to participate very early on in the acquisition process of a build-for-rent community. So the steps are pretty straightforward. We identify land. We put that land under contract. We then go into a period of engineering, some initial architectural. We need to do environmental, et cetera, to make sure that we have a viable project. With our experience, we're very confident that we always have a viable project going in. But what the expansion fund does, it allows an investor to come in, like I said, in an early part of the project in a fixed income structure at the beginning. So it's not leveraged against any particular asset. That investor then gets preferential treatment to roll that capital into what we call a co-GP scenario as we begin to move into land acquisition and actually closing on the land. When they come in as a co-GP, they're participating obviously in the GP economics, and the equity multiples become incredibly robust when we start looking at the time of transferring from land acquisition into them bringing in LP capital to finish out the capital stack so that we can then move into bringing in the construction loan and doing the verticals on the projects. So we have that funding structure in place right now. We have approximately, last count, I think we just put something under contract yesterday, but we have approximately $300 million in development in our pipeline right now, which are opportunities for our investors to do their own due diligence on, to take a look at what it is that we're doing, where we're doing it, what our plans are for the projects that we have in play. So that's the basic outline structure that we're working with as it stands today. Again, it's an expansion fund that allows investors to come in early in the project, receive a 10% fixed income on the capital deployed, and then to roll that capital if they choose to and participate in the co-GP position early in the development process, that offering a more aggressive return profile on the deals.
So, Dave, thanks for covering about the fund and exactly what the focus is of the fund. But now, just taking it a little bit more further, so can we look into certain opportunities that you target? If you have those in your slides, so we can have a look of exactly what we are talking about, and also an idea of some of the, if there were generated returns from previous times, then an idea of exactly the previous track record as well around this.
So these are projects that are in various stages of development. These are all built for rent, single family communities. Just to give you some ideas of what our product looks like. This is our larger product, a 2,200 square foot. We refer to our product as villas in the single family marketplace. The single family assets, the smaller assets would look like these projects here. So the two 34,740,000 capital stack projects, there are two identical plots of land in the north of Cape Coral, Florida. They will accommodate 134 single families on each of those particular plots of land. There is a larger one also in Florida that we have in discussion. I believe it's in contract. It's a 380 unit build. And then a larger project up in Rotunda. Just to give you some idea on size of projects that we'll work anything from these size of projects down to smaller projects. We just put a nice little $6 million project under agreement yesterday for a 16 unit townhouse property in northern part of Florida. It's by Rotunda, which is in the middle of the state. So that's another project that we have in place. I don't know, Eric, do you have pro formas on these or any of these projects that you could maybe share in another room if anybody has an interest in learning them? I'm not I don't have the pro formas on my presentation to be able to go through some of those numbers. What I can share with you is on this slide here. This slide will give an investor some idea of how we use fund capital that comes into our expansion fund. You can see if you take the Cape Vista apartments as an example there, the engineering costs, the architectural costs, the capital we deploy for renderings, legals on everything, property taxes. So you can begin to see that as we begin to expand our acquisitions through our teams, we're bringing in some capital to get these to the point of entitlement, to get the permits in hand and grow. So that's what we use expansion fund capital for. We use it as a part of our capital stack to be able to execute on these deals. And as I said, it's a 10% fixed income return, but the ability to roll that capital into a position in these projects once they pass that point of, or they get to the point of the actual land acquisition. So I don't have pro formas. I didn't know that we were going to be putting out actual deals like that in this format. But I can definitely share pro formas and structures that we use in a more
we could also we could share the renderings of the 42 unit in Tampa that we're working on. That link is live. I just put that link into the chat so we can pull that up and show everyone a sample of what these communities look like. It's a smaller one, 42 units, but that'll give a good sense of what these communities look like.
That's excellent. Thanks a lot for that, Dave, and for giving us an idea of exactly what's happening in the market there, and the kind of opportunities that you're currently working on. Definitely gives a bit of flavor on what investors can expect. Now, any word of advice that you would give to investors who are there right now for the podcast, but more so the ones who will be joining the Ask an Investor room, who would be seeing this and listening to this session later on in the future as well, in terms of exactly what they should consider and what they should look into when it comes to investing into this specific space of in real estate, and how you would specifically be able to help them, in which ways you would be able to help them as well.
Yeah, great questions again. Look, we made a mission statement very early on with our company that an educated investor is a better investor, because at the end of the day, that investor is a partner with us at the company. Passive investments are great, but being educated and fully versed on what the asset is that you're coming into, understanding its pros as well as its cons. I was at a Globe Street event recently, and one of the guys from one of the larger institutions was speaking on stage, and he said, just understand that your pro formas are always going to be wrong. And look, as educated operators and investors, we all know that. We shoot for very best scenarios. So my advice is always get very, very familiar with the GP, with the operators, because at the end of the day, sticks and bricks are sticks and bricks, whether it's $100 million project or whether it's a $100,000 project. The fundamentals are pretty much the same. So what are the variables? Well, it's the skill sets, the personalities, and the drive of the operators that are executing that project. Every build for rent community, every multifamily community, every office build, every large skyscraper is a business in and of itself. Every business has the same exposures and stresses. So understanding what they are through great questions, due diligence is critical. There's a lot of capital in the marketplace, and my own personal outlook on it is I've seen a lot of capital move towards mediocrity. And I kind of have a little bit of a mission statement internally from my blue collar background in construction, and I was a firefighter. So I'm always very aware of what's out there, right? I'm very aware of what opportunities are in the marketplace, and I see, to be very frank with you, I see a lot of crap out there. Not to tear anybody else down, to build us up, but at the end of the day, the fundamentals are the critical drivers. So the team to execute the plan, know the team, understand the team. Are your financial goals aligned with their business plan? And if you can say yes to that, then due diligence is getting to understand the deeper processes involved, the stresses, like I mentioned, and being able to execute. And is there good communication, right? Once that capital is deployed into an escrow account or into a fund account, what does that communication look like afterwards? Do they have a comprehensive investor platform where questions can be answered? And we were very cognizant of building a great infrastructure to be able to service our investors going forward. So I know that was a little soapboxy, but that's how I get sometimes. My number one job is to be a steward of other people's capital, and I don't take that position lightly. So, but we look forward to building relationships, having good conversations, and finding some alignment.
That's great, Dave. And in addition to that, I mean, if there are, because you mentioned about investors doing their own due diligence, it's always great that operators like yourself would be able to set the path of educating them directly, rather than because sometimes what happens is, because you definitely own the investing for the investors, but sometimes what happens is a lot of middlemen usually get involved rather than the investor directly in terms of a lot of the communication, and because of it, sometimes not the right things are communicated. So. I mean, one of the important things for us as well is that it's important that you get the feedback directly from operators sometimes, so that you understand actually what is going on. So yeah, we will be really interested in yourself, Dave, helping in educating the community as well to know what is happening and whatnot, to post some of these resources so that people can get a lot more comfortable about what is happening in the market. And also have their own understanding to determine whether there is a bubble or not. So anything around that, if you're already doing something around it, then please do let us know exactly where to point, where the investors can be pointed to. Or otherwise, it will be great if you can build that in the community in Quidroom.
Yeah, we have pretty, I wouldn't say extensive, but a very dialed in education concept within the company. There are multiple blogs and podcasts that we have done to share our visions, our mindsets, to bring folks up the education gradient. There is a white paper that I believe folks can download. I don't know, Eric, whether you could drop the link to the white paper. What is a position for alternative investments in a portfolio? We put a substantial amount of work into that, to bring folks up that education gradient. I know it sounds so base and so basic, but it amazes me how people ask questions just for the sake of asking questions. But when you really dial in what it is that an investor wants, and it's up to them to be able to discern that for themselves, it's a lot easier to give direction and give opportunities to an investor who knows exactly what it is they want. Some investors want cash flow. Some investors want yield. Some investors want a short run. Some investors want a long run. It all depends on what their specific needs are. We can educate them, and then we can offer them the opportunities that we believe would fulfill that investor need going forward. So, I'm a simple guy. I don't like to overcomplicate this thing, right? It's putting really good deals with oriented capital, knowing that they're both moving in the same direction, great communication along the way, being responsible for everything that goes well, but also being responsible for the things that don't go well. This isn't a certificate of deposit that's going to pay you 0.03%, right? It's not that world. This is real estate with its challenges and its stresses, but with collaboration, I believe we get massive results. So that's kind of a little bit of the philosophy behind what we do on the education side.
Thanks, Dave. Now, there is another question that came in from another listener, and it's about and it's more about giving an understanding of providing an understanding of or your assessment of how single-family real estate or multifamily real estate are performing versus other commercial real estate assets at this point of time, and what your thoughts are about how they will and how the performance is going to skew later in the future.
Yeah, that's a great question as well. I can only ever, share what I know. And it's in the multifamily arena, existing assets. As I said earlier, there's been a massive compression in cap rates. So with that massive compression in cap rate, we see a reduction in pro forma yield. What's also interesting about the multifamily, and when I say multifamily, I'm talking about existing structures. I'm talking about 50 to 150, 200, 300 unit apartment complexes throughout the U.S. We've seen that compression of cap rate nationwide. However, what's been very interesting to see is rent increases just being off the charts in comparison to the consistent 2 or 3% that we would underwrite any one of these assets for rent increases. We did a very small $2 million deal in West Palm Beach, Florida on an existing structure. It was a 14-unit asset. And my guys underwrote it at 5% rent increases. And I looked at it and I said, what are you guys doing putting in 5%? They then pulled down the data from our data supplier, and it was a 15% year-over-year rent increase with projected 3 to 5 year increases at the same numbers. Now, for me personally, when I'm looking at that kind of out of the box norm for targeting for underwriting deals, I get uncomfortable, which is again what I say, bringing it back to the fundamental. Everything will find its level going forward. So you've got this increase in cost of multifamily assets. The ability to reposition them is a challenge because they're being purchased at such a high price. Some of this stuff, some people believe that some of these assets will be performing at a negative yield in the next 3 to 5 years. So what does that do for a guy like me? Well, I build in my valuation, I build in my yield based off of what the demands are in the market, which goes back to what we were talking about earlier, where Florida, for example, the population growth in Florida is approximately 1,500 people a day. That 1,500 also brings a massive amount of support staff to that population as well. And what I mean by that is it's still the number one retirement destination in the United States. And for every one retiree, it creates 4 service jobs. A lot of these people need somewhere to live, and they don't all want to be in these apartment complexes. And a lot of the apartment complexes that exist in what we call an A-class asset with, the extra swimming pools and the tennis courts and that kind of stuff, that's not what we're building. We're building clean, decent, affordable homes that people can come in and their rent is palatable, and we can still build in enough yield for them going forward. So it's definitely an interesting time. Now, how that compares to retail, I couldn't tell you. I'm not a retail commercial investor. And when I say retail, I'm talking about, apartment. I'm talking about strip malls and the larger malls and your chain store type investments. What I will say is that self-storage as an asset class is attractive. It's also seen a compression in cap rate, but its demand is also very, very high. With all of this movement of people, it creates a lot of opportunity in the self-storage world. So we're beginning to look at some of those things. I have some really good alliances and GPs in self-storage, but I stay in my lane. I try to be as highly proficient as I can in one area so that we can perform. So anyway, that's kind of the best answer I could give you on that.
No, that makes sense. And because we are running out of time, I will just there are 2 questions that were asked by one investor. I just want to run it by very quickly. One was about how do you compete right now when it comes to the market of Florida, especially with a lot of large real estate managers and institutional investors also looking into that space?
Yeah, that's such a good question. We compete because we're boutique. That's really the bottom line answer on that. Real estate is as much location as it is who you know. And when an ideal parcel comes into discussion in the Florida market, we are usually one of 3 or 4 what we call boots on the ground investors that get that phone call. these larger institutions, I always use the analogy of the Titanic and a speedboat. The Titanic will take a long time to move and adjust and execute. Whereas we as a speedboat, I can go in, look at a piece of property in 24 hours, put it under contract in 48, and now I've controlled that contract and that potential investment opportunity. Our team on the ground is extensive. To be able to call the right person at the county to get the right answer with speed is a massive advantage. Will we meet capacity in the next 3 to 5 years? Probably. We're looking for scalability into other markets to be able to execute the same way. But for us, we would much rather build a very strong infrastructure and foundation as we expand into other markets and maybe some of the northern parts of Florida. But as it stands right now, and this is going to sound egotistical, and please don't take it this way, but the good deals, we've seen them first, right?
Okay.
And we're able to take those down with speed, whereas some of our competitors need to ask 2 or 3 people permission to make money. We don't need anybody's permission. we could execute with speed. So.
Makes sense. And Dave, coming to the last one in here, it's more of an observation from this in the observation, the real estate price and the real estate investment prices are going really higher around the world. So it's not only in the US and especially on the residential side, right? So the question was more about, do you feel that the prices can and the budgets would be better managed with further collaboration with government and private corporations in the horizon? Is that going to happen? And this is mainly because a lot of middle income people are suffering because of this high growth in prices, and the investor just wants to know whether there's going to be that what is the point of improving towards more smart end technologies if it's not helping the general to afford a house?
That's such a great observation, right? We put all the bells and whistles, and everybody gets excited about an ESG investment, but the ESG investment increases the cost basis by 10, 50, whatever the numbers are, and it's like I'm trying to be a more, I don't want to use the word moral because that's not right, but a more aware, environmentally aware investor. And yet, my technology and my environmental awareness increases my cost basis. And now I can't find somebody who can afford to either rent and or purchase that acquisition. So it's a great debate to have. But what I'll tell you is this is, again, we made a decision to be able to provide clean, affordable, decent homes to that middle class, right? I came from an English council estate, and we thought we lived in a castle because we had a clean, decent, brand new, council home. So that was my background. So when we get into the environments that I work in today, I'm kind of like, my mentality is to reproduce that, because there is an absolute need that has to be fulfilled. When you talk about alignments with government programs, I've been blessed to be in that environment in the past. Like I said, I teamed up with Martha Coakley from the Attorney General's office, and I was known as one of the top distressed asset investors here in the state of Massachusetts, because I learned how to partner with the government programs. So over here in the States right now, we've got opportunity zone investing, which is a taxation benefit for investors. That's a program that we're familiar with. There's various funding programs that our team will look at to be able to be more proficient in getting a good tenant base in place for us. So we're very much aware of that, and I think that's a fantastic question, because it really does creativity. Let's use that, right? It's not just the same old every single time we go into an investment. we reverse engineer everything, and it starts with who is the tenant, can they afford it, do they want it? If they can afford it and they want it, then let's build it. And with that simple mindset going in, we've created success. So it's an interesting time. Yeah.
Yeah, and Eric, in the side in parallel to that, while you were explaining this, Dave, Eric had posted quite a bit of resources around this about affordable housing and government programs that are there to support this. So this is great. What we'll do is from our end is that we'll just repost these things in the investor community in Quidroom as well, so that they would have these resources for future, and anyone who has these questions would also get answered as well from our end. But on a concluding note, Dave, this was a great session. Your passion about what you're doing is contagious. It's amazing.
Good. Yeah. Look, man, if I'm miserable, I don't want to do it. If I'm not having fun, if I don't believe in it, there's no point in getting out of bed and doing it, right? We can all figure out how to make a buck, but it takes a little bit more to figure out how to make a buck and also, make an impact. So thank you for acknowledging that. So yeah.
No, absolutely, and I love what you are doing, and I'm sure, and anyone who's going to be listening to this right now, and who will be listening to the future podcast as well, feel free to reach out to Dave, to Eric, and to rest of the team in Freedom Ventures. You guys, if you have any questions in regards to real estate, rental real estate, single family rental real estate market in Florida. The guys know exactly what they're doing. They would definitely be able to patiently help you with all the questions that you have, and then from there you can take a better educated decision on, is this a market where you would want to spend a good amount of bucks from your pocket or not. Thanks, Dave. It was great having you on board.
Thank you for the time, gentlemen. Yeah, thank you. I look forward to doing this again soon. Take care.
Take care. Bye.
Bye-bye.